Oh, goodness. Hey guys, Brian Steve. As you can tell, it's raining outside, and I just went and got my coffee. And it's not drizzling, it is pouring. You know, in Seattle, it's like one of the cities where people just don't carry umbrellas. They know if you're out of town, if you're from Seattle and you got an umbrella. So I kind of have the spirit of a Pac Northwesterner, as I got a lot of family up there. Hi, guys. And so I decided not to have an umbrella today, and I paid the price. I am soaking wet. But anyways, not the price. Not the point. Today we're going to talk about a bunch of really interesting things. We're going to talk about portable mortgages. What the hell is that? We're going to talk about the Zillow soap operas. And they're, by the way, it is definitely a soap opera. We're going to be getting more inventory, and we have politicized or weaponized the mortgage industry. And now there are prices to be paid on both ends for erratic behavior. I don't know about you, but I just want to vote every politician out. All of them across the board. As far as I'm concerned, let's just start fresh. And, you know, it's like, what do they say for the president? You can't be under the age of 35. I don't think you should be able to be over the age of 70 or 65 and be a politician. No offense, this is not age discrimination here, but don't we need some young blood? My God. And I'm old by everybody's standards. People younger than me. Get young people with great innovative ideas. Let's make them politicians. But before that, let's jump into the things that we have to talk about today. Okay, and as you know, if you're watching this on Zillow, or excuse me, if you're watching this on YouTube, you know that this is going to be kind of a rough draft for what our show is tomorrow, so you're just kind of getting to see where we're coming from. All right, let's get started here. All right, a lot of stuff going on today. I thought this was pretty interesting. I think it's the second time I've shared what's going on here. Oh, nope, hold on. There we go. Different person. Thought this was interesting when I was checking out my Twitter feed. I get a ton of great information from Twitter, but I thought this was good from John Cooper. Horrible jobs report. The private sector lost 33,000 jobs in June, badly missing expectations for a 100,000 jobs increase, ADP says. Can anyone spell recession? I can spell depression better than I can spell recession. I think this thing, this market, guys, every day I wake up, it is just another day with a bunch of insanity, moves of desperation that are taking place. I don't know why this surprises anybody. We keep hearing positive information from both sides of the aisle about how things are going great, and they're the reason for it. And anything going wrong is the responsibility or the problem from the other side of the aisle. It's all this bickering and infighting. And the truth of the matter is we don't know which direction is up or down, do we? There's a couple of reasons for this. One, when we had our government shutdown, again, another sign of a dysfunctional relationship our politicians have with each other. They quit doing our reports, so we could not see the reports that we use to anticipate the direction the market is going to go via, frankly, guidelines, obviously interest rates and inventory. So we're not seeing inflation, all of these. We didn't get any of these reports for a couple of weeks. But you know what the big kicker is? The reports that we're getting are not worth the paper they're written on as they were in years past. I constantly talk about this. We've created a false market. And as a result of the false market that was superimposed on the mortgage and real estate industry, our previous and steady Eddie indicators that we would use to figure these things out, they don't work. Case in point, we thought we were going to get 100,000 jobs. We lost 33,000. That is 133,000 job swing. It's kind of like this if you watch football. You ever have it where your team's on the 1 yard line and they're ready to go and it's first and goal at the one, and then all of a sudden they run it 3 times and they're going to go for it on fourth, and then the ball pops out. Linebacker from the other team takes that ball, runs it 99 yards back and scores a touchdown. Is that a 7-point shift? No, that's a 14-point shift. You're taking away my touchdown, which was inevitable, which is 7 points, and you tack 7 on the other team. It's a 14-point shift. We thought we were going to see jobs go up. We lost jobs. This is that fumbling the ball on the 99-yard line. And yes, it hurts really bad. And yes, this is going to create issues. However, this should push mortgage interest rates down, which is what everybody wants. I don't. And this should also really kind of embolden the Federal Reserve to start their quantitative easing. If you don't know what that is, check out my show from yesterday on Mortgage Shots, and we're going to be doing a four-part episode on inflation and the effects that it has on mortgages. And there's a great study I got from the Brookings Institute, and we're using that as a backbone. So check it out yesterday, and then on Monday we will be doing the second installment of that. But anyways, yeah, the indicators, we didn't get them, but even if we did, they're not reliable. Foreclosures, my friends, they surged 20% as Americans struggled to pay mortgages and fears of a 2008 style crash soar. 2008 and then some. We're going to call this the plus one. World War I was a big war, and more people died, I believe. More soldiers died, but World War II is the one that everybody remembers. We had the Great Recession Part 1, and now we just call it the Great Recession, just like they called it the Great War. Then after World War II, they said, we're going to call the Great War World War I. So we're going to be calling this Recession 1 and Recession 2, just like the wars. And again, this is not something that's intended to scare anybody. Frankly, I think this is the invariable correction to the market that we absolutely have to have in order to get to a market that has a semblance of sanity, provided our politicians stay at bay. In October alone, there were 36,766 foreclosure filings of first steps in the process. When a lender warns a borrower they're in default, that's up 3% from September 19th from a year ago. Foreclosure activities continue a steady upward trend in October, the 8th straight month of year-over-year increases, and this is according to Atata Alms, Rob Barber. Adam does a really good job at this type of stuff. Ron, working at Adam, does a good job at this stuff. And this is something we've talked about here on Mortgage Shots in the National Real Estate Post now for the past year, that this is an inevitability. People say, well, it didn't have to happen. Oh, bull. Yeah, it did have to happen. And you could see this thing being projected from miles away. Suffice it to say, adjust your sales accordingly and make sure you're doubling down on your work. As far as loan officers and real estate agents go, I just want to say this. If you work a solid 8-9 hour day, I mean, work it like you're going on vacation in 2 days. Remember those days? I'm going to be gone for a while. Better get everything done. Work every day like that. Do it from 8 o'clock in the morning, work till 6 o'clock at night. And if you bust your ass and you time block and you call your past client database, which I call your best opportunity, if you have strategies, if you're getting lists, if you're out there kissing babies, going to events, talking with your community, you'll be just fine. I mean, to think about this, like right now, I think the median sales or median loan amount for me out here on the West Coast is somewhere to the tune of, $650,000, $700,000. If I close one loan a month and I make 1%, that's $84,000 a year. If I close 2 loans a month, it's $164,000 a year. 2 loans a month is nothing. If I gave you $10 million right now to go find 2 loans, if I gave you $10 million to go find 2 listings today, could you do it? I'll guarantee you this. You have real estate agents pounding on doors everywhere, calling just like a madwoman or a madman, going out there and calling unlisted properties. Did you know that properties that decided to delist is up 52% from this time last month? They're delisting their houses because sellers want to get more money on these properties. If I was a real estate agent and a lender, I would go get all the information at my disposal, for which there is a pile, and I would get all these delisted listing people, and I would say, hey, listen, I want to just talk with you about the nature of real estate and what your dreams, aspirations, and moves you would like to make. And then let's see if we could track something else down other than what you're doing with your previous agent. Because I have a sneaking suspicion that these agents aren't necessarily getting into what's happening with the market or the economy as a whole, anything that's beyond surface level. I would deep dive this stuff. Go pull stuff from the St. Louis Federal Reserve. Show them housing. Show them delistings. Show them interest rates. Show them a 75-year history of interest rates, and that a 6.5% interest rate, that ain't bad. And you're below that right now on most all of your loans. Rates are not the problem right now. Show them what happened in 2008. Explain to them that we lost 47% of our value on our properties, and what you think might be a lowball offer today could be a great offer tomorrow. So if you are inevitably going to be selling your house, sell it today, because the future right now looks a little bleak. Further, then hand it off, kind of like fake wrestling, tag team your partner so your partner can get in there and just, rough them up a little bit, and talk about loans that are outside of what your normal loans are, your agency loans, your Fannie, Freddie, Jenny loans. No, I would talk, listen, by the way, I'm doing a bank statement loan right now. I have a 12-month bank statement loan. I priced it out, and I shit you not, it's a jumbo deal. It's better than jumbo pricing that you're going to find with all your agency lenders. It's absolutely night and day. Talk about the different programs. Talk about the opportunities. Talk about diversifying their real estate holdings. If they're selling their house and they have enough equity in the property, they might be able to buy an investment house, buy it in a different state, and buy something that's going to be cheaper and something that pencils on day one. You can create cash flow and you can create more investment opportunities for your listings. There's so many ways that we can keep these people from delisting, but because most real estate agents and lenders don't have the acumen to have these conversations, then you go do it on these ones that delisted. Again, up 52% from just last month. These numbers are staggering. By the way, the states with the most take it again, Brian. The states with the most foreclosures. Number one, can you guess it? Oh, we got to play the map game here. All right, number one is Florida. Number two is South Carolina. I'm a West Coast guy, so this is pretty impressive. Number three is Illinois, right? Let's see. That's Minnesota. That's Wisconsin. I believe that's Illinois. Okay. Number four, is that Maryland? Number five, oh, I got that. Nevada. Number six, Iowa, I think. Number seven, maybe that's Iowa. I think that's Iowa. Do I have to cheat this? Seven, what is it? Let me know in the comments. Let me know. So what's the seven? Am I missing this? Anyone? I think what we're staring at here, guys, is Ohio and Iowa, because number 3 and 6 is Indiana. So that is 3 is Illinois. 4 is that Maryland, Connecticut, Rhode Island, one of those. 5, Nevada. 6, Iowa. 7, Ohio. Am I right? All right, let's go. 8, that looks like New York, the big one there in the corner. 9 is going to be Utah. And 10 is going to be the state of California. Boy, I really thumbed all my way through that. Suffice it to say that we're seeing foreclosures go up, and this is a trend that is not going to change. In fact, we are going to see more foreclosures. The agent and loan officer who know how to deal with this are the agent and loan officer that are going to succeed in the market going forward. As our foreclosures increase, by the way, I do want to explain this point, is we are going to start to hear the F word happen a lot, and the F word is fraud. I told you before, our regulators are going to go out there and try to cut their teeth and make reputations for themselves going after companies and individuals for fraud. We're already starting to see it happen. When foreclosures go up, the assumption is that all of us lenders got together, all of us loan officers got together somewhere, and we all agreed that we were going to start lying, cheating, and stealing more. Does it go up in times of desperation? Perhaps, but what really goes up is the people who get out of this business. I don't think fraud goes up, but these files are going to be looked at with a fine-tooth comb. And what may just be an oversight on yours or your processor's behalf, or maybe laziness, that will come up as fraud. So just be careful about this. And of course, the reason is because we have to put the onus of responsibility for the shit show that the real estate market is right now on the shoulders of loan officers and real estate agents, you know, the people who could do nothing for themselves, and not the politicians who set these ridiculous policies. Here's the states: Florida, South Carolina. Oh, I got it here. Illinois. I was right on that. Illinois. Oh, Delaware. Screwed that one up. Nevada, 5. Ohio, did I get that one? 6. Iowa. Oh, got him right. Maryland, 8. Wait. I think I did get that one. Maryland is 8. Utah is 9. California, 10. Followed by Texas, New Jersey, Idaho, D.C., and Oklahoma. It's also worth pointing out, if you go and look at that, it's sand states. Sand, sand a little bit here. These would be the sand states. It's primarily the states along the coast, and they're always leading the way when it comes to foreclosures. Did you know that China is dumping $500 billion in bonds while buying gold for the 12th straight month? The housing market connection nobody is talking about. Boy, this is actually kind of a big one here. Countries are dropping U.S. bonds like nobody's business right now. Dropping U.S. bonds will have a negative impact on mortgage interest rates. Why are they doing this? I don't know. I think it's a power play to try to become the largest economy in the world. And one of the ways of doing it is trying to destabilize the United States dollar or make it not the currency that the world uses. When foreign central banks dump treasuries, yields rise. Higher treasury yields equals higher mortgage rates, even if the Fed pauses. We're not just fighting the Fed anymore. I love how they put it. We're not just fighting the Fed anymore. We're fighting the global de-dollarization trend that is taking place. The 10-year Treasury yield directly influences the 30-year fixed-rate mortgage in China and other BRIC nations following the same playbook. Keep reducing Treasury holdings. Mortgage rates stay elevated regardless of what Powell is going to do. Remember, Powell is jumping back into quantitative easing as a means of pulling interest rates down. You've got all the BRIC countries that are dumping treasuries that are pushing interest rates up. We've got bad job reports. We thought we were going to get 33,000 jobs. We lost 100,000 jobs. That is good for rates. So we have got good and bad on the scale when it comes to mortgage interest rates. What is going to happen? The answer is probably not a whole bunch. They will offset each other. You might see a slight rise or a slight decrease in rates, but we're not going to see anything significant. But as I keep telling you guys, quit thinking about rates. If you are a buyer, buy in a higher rate environment. Why? Well, right now, this market alone, specifically this market, you don't see markets like this. I talked about this yesterday with home prices, inflation offers, 50-year mortgages from that Brookings Institute studies. Here's how it goes. When rates go up, it's generally a hot market. Why? Well, because we have more demand on limited money supplies, so the value of that money goes up and it's realized in the form of higher interest rates. When we want to borrow more money for mortgages, it's because people are getting mortgages. That makes sense, right? So when rates go down, it's because people aren't buying. Okay, so there is less demand on our money supply. So we discount the cost of our money in the form of lower interest rates. So they go up and down together. This market, again, we cannot trust our previous indicators, is different. This is the unicorn market. We are trying to get rates to go down in a market, in a market that is sliding. But we've got pressures that are pushing them up. So if you buy a house in a higher rate environment right now, you are likely, in this market alone, to get more concessions from the seller. Think about this. If rates go down by 3/8, that would be 0.375%. If they go down by 3/8, on a $500,000 house, you're going to save $40 a month. But now there's going to be a ton of more people bidding on that property, so the property value is going to go up, and it's going to offset the $35 that you would have saved with the rates going down by 3/8. Because there are more people pushing on that property to buy it because rates have come down, and there is a misnomer that it's better to buy in a low rate environment all the time. Because here's what happens. When the rates go down, the property values go up, right? Now what happens is, and when you buy in a higher rate environment, you get more concessions. You could probably even buy that rate down, and you're getting the house at a cheaper price. And with that cheaper price comes a lower tax base, right? Now, if rates go down, demands go up, property values go up, then you're buying that house with the same payment because the higher price is going to offset any lower rate that you perceive is going to be better for you. But the fundamental difference is in a low rate environment with a higher sales price, you're going to pay more taxes, and you're not reversing those. You will have lower taxes in a higher rate environment, which is going to ultimately push your overall payment down. And besides, you can refinance. The 10-year Treasury yield directly influences the 30-year fixed rate. Okay, so we did this one. Okay, the Trump administration is actively evaluating portable mortgages. What you need to know. Here's what you need to know. This is a move of desperation. That's all this is. The Trump administration has another idea to make housing more affordable. Let homeowners take their mortgage rate with them when they move their house. Boy, this one sounds like a shit show waiting to happen, doesn't it? Okay, so I take my mortgage. I got $300,000 on my mortgage. It wants to stay in first lien position, but I'm going to need a $450,000 house to buy the house that I'm going forward. So do I get a second mortgage? Because the new mortgage on that property, if I'm carrying my mortgage with me, is going to be in second lien position. So I'm getting an adjustable based on the prime, which is sitting at 7 right now. I add my margin to that prime, which is going to be 3. So now I have a rate of 10% on a good day on a second mortgage for $250,000 or $150,000. So the blend on my first and my second rate is going to be, oh, I don't know, probably somewhere around 6%. If you rewind what I just said, it mathematically pencils. So that blended rate of 6% between my first and my second is going to be the exact rate I would get if I were to just go out there and secure a whole new damn mortgage and not have to deal with the first and the second. This is desperation. Just like the trinity that I told you about the other day. You know, by getting rid of credit scores, by giving away free money, by looking at 50-year mortgages. These are moves of desperation by policymakers who have no idea what they want to do. If you've been following any of this stuff, the 50-year mortgage that Pulte, he was the head of the FHFA, was pushing Trump to push. That thing is getting its teeth kicked in online right now. It's bad because it's a bad idea. Now we're talking about portable mortgages. This screams desperation that we don't know what we need to do in order to get us out of this. So let's just throw anything against the wall. Let me know what you think, though, guys. I want to know what you think. Maybe you think portable mortgages, and maybe I'm misreading this thing completely. The surprising reason home prices remain stubbornly high. Nationwide delistings, as I told you a moment ago, delistings rose by 52% in September compared with, a year before, after peaking at the 72% of their annual growth rate in August. This is according to fresh data from Realtor.com. That's up from September 2024 when delistings rose 46%. Real estate agents, again, people are delisting because they're pissed they're not getting their price. I would go to all the delisted properties, figure out who these people are, sit down and have a conversation and say, I would just like to talk about your aspirations and the reality of the market. I don't have a dog in the fight. Would it be okay to sit down and have a cup of coffee with you? And then give it to them both barrels right between the eyes. It's a great time to buy a house right now. These are the activities of top producing real estate agents. Fannie Mae officials are fired amid mortgage fraud probe. I love this story. Members of Fannie Mae's ethics team, I love that. It's the goddamn ethics team. Members of the Fannie Mae's unethical team were dismissed following an investigation into FHFA Director Bill Pulte's allegations of improper access to mortgage records of Democratic officials. The probe referred to the FHFA, OIG, and the U.S. Attorney's General Office raises questions about proper authority and procedures. It's apropos, as they say, that this is the ethics committee. But does this surprise anybody? Let me ask you this. Put this in the comment down below. What do you think our politicians are currently not capable of? Better yet, what are you frightened that you think our politicians are capable of? I ask that because do you believe that we have weaponized the government-sponsored enterprises as a means of currying or swaying political favor in the direction of you, even if it's true or not true? Do you think our politicians would do that? I certainly don't. I wonder what Jeffrey Epstein's doing today. Inside Zillow's legal storm. You know me, I'm not a huge fan of Zillow. We'll just get it out there. I not my favorite. But I don't know if they did anything illegal. We allowed them to do stuff they shouldn't have gotten away with, but because we didn't put up a fight, I mean, to the spoils go the victor. To the victor goes the spoils. The reason I say that is because Zillow's huge. They're the big. They've turned into the 800-pound gorilla in the room, and they have enormous influence on buyers and sellers. Frankly, I think they're kind of responsible for the fact that we're not moving as much inventory as we otherwise would. So anyways, CoStar has a lawsuit against Zillow. In the suit filed in late July, the U.S. District Court of Manhattan, CoStar accused Zillow of rampant copyright infringement of listing photos. Are they doing it? Hell yes, they're doing it. Oh, I didn't put these right. All right, so now I got to do it this way. All right, sorry, Grant. Hira versus Zillow. Filed mid-September in the U.S. District Court in Denver by Samuel James Hira, who calls himself a Day One Zillow employee. The lawsuit alleges that Hira was wrongfully terminated by Zillow in February 2024. According to his complaint, Hira was forced out. Okay. CoStar, we know this one. The first lawsuit filed by a home buyer plaintiff, Alucard Taylor in U.S. District Court in Seattle mid-September. The lawsuit alleges the portal tricked consumers into using agents affiliated with Zillow through its Flex and Premier agent programs. They would never do that. All the time. Compass versus Zillow. Filed in late June 2025, the lawsuit contends that Zillow's listing access standards policy, which bans listings that are not available for display on Zillow within one business day of them being publicly marketed, stifles competition and has caused irreparable harm to Compass. Here's the whole deal. If Zillow had their way, they would snuff out Compass, wouldn't they? And frankly, if they do, I mean, isn't that the idea of business, is you snuff out your competition? I think it is. I don't begrudge Zillow for it. I don't like Zillow, but I don't know if these lawsuits are entirely fair. It goes something like this. In real estate and lending, the more successful you are, regardless of your activities and actions, the bigger target you are. And none of these policymakers or legislators are getting out of bed for under $1 million. Zillow, well, like I said, they're the 800-pound gorilla. So these are our dilemmas for today, which is going to be Friday, November 14th. My question is, what are you going to do about it? You can reach out to us on our team over here, and we can help you out because we do things differently. With that said, you guys make it a great day. I appreciate